then finally, noncompliance with tax credit rules really contributes as a reminder of that purple line that we drew about tax credit risk. So all of these risks in this ominous orange color here really make the investors and the fund and the syndicator on behalf of the investors and the fund want to mitigate those risks and want to have certain guarantees made. And so here, during the construction period, we have what's called a development completion guarantee. The other is the rise in operating costs, drop in rental revenue. So we have a net operating income that ends up waning, so to speak, not being as we hoped or expected. So there's an operating deficit guarantee. And then finally, this risk here, there's a tax credit guarantee. Sue, let's go ahead to you. Discuss any of these three guarantees, or all three.
Our transactions include all of these guarantees. The ones that are the most crucial are going to be the early stage ones, which is getting the project built and occupied, and really the first 3 years of the project, because that's really where the project, if it's going to run into a problem, is most likely to happen. The project has to lease up, it has to establish. If it turned out their projections of expenses or whatever was a bit off, that's where it's going to surface. So we really take those guarantees very seriously. We do find that there is a risk in those later years, and we do have the protections built in. In reality, we think that those are probably less of a risk than we think these first two are. Mm-hmm. So the first two, we actually make sure that we've got, in the structure of the transaction, there's money set aside to help strengthen those guarantees, and then that money is gradually going to be released to make more comfortable.
Mark?
I'm in total agreement that the risks are the first 3-4 years. Once you've built the building, delivered the credits, you've got perm debt, you've stabilized. 95% of your risks, at least traditionally, have gone. And I think I would also emphasize that all the partnership agreements we see have all of these guarantees as you've described them, and that development guarantee is typically an unlimited guarantee, and it doesn't burn off until such time as you get perm debt. So you've got to stabilize perm debt and deliver these credits. And that's when both the developer's at risk, probably appropriately, and where the limited partner has some exposure. A different risk that we haven't seen in the past, but maybe something coming, is that our rents are limited to 30% of whatever median income our set aside is.